Hello and welcome. My name is Chris Cann with Mining Journal, and with me I have Paul Atherley, Chairman of Angola-focused Rare Earth Development Group, Pensana. Pensana this week announced its Longonjo project was fully financed with 156 million in debt secured, and there's an 80 million equity component that's in advanced discussions, and that more than covers the 217 million needed to see the project through to commissioning. Hi there, Paul. Welcome.
Hi, Chris.
Paul, we're aware, painfully aware, that getting capital raisings away in the current market, both debt and particularly equity, is very, very difficult. Can you talk us through how you've managed to execute this package and then the strategy behind building it the way you have with the different components?
Yes, well, thanks for the opportunity, Chris. As you know, the company hasn't relied on the equity market to get where it is today. We've had 70 million US dollars invested in the company by the Angolan Sovereign Wealth Fund, FSDEA, M&G from London, and myself. I put around £1 million into the company. So essentially, we've got three major shareholders funding the company today to get to where we are now. And we recognise that at this point, the debt and equity markets in London just weren't there for us. They're not there for many other junior companies. So we've taken a different approach. And it was recognised the key hurdle for many of these projects is the upfront capital. If your upfront capital is too high, doesn't matter how good the project is, you're not going to get there. So we're fortunate we've got a very good project. It's got very, very strong early cash flows, very, very high grade, near surface, great infrastructure. And the team were able to re-engineer the project down from just over $300 million upfront capital to just over $200 million upfront capital, including a contingency. And that put us in the envelope of being able to finance the project at the asset level rather than at the company level. So the term sheet that we've received and announced is based on a project financing of around 60% of the requirement for bringing the mine to be fully developed, build a refinery and commission. It's a overall 7-year facility. It's basically a build, commission, and then a run time of around 4 years to cover off that period. And a requirement of it is three things. One is we need export guarantees from a relevant export guarantee agency. We need to finalise our offtake agreements, which we've announced. We've got a more than 100% offtake agreement. We've got a lot of demand for our very, very clean, high-grade product. And then finally, we need to finance the equity components. And again, rather than go back to the equity market in London and try and do it at the head company, we're doing it at the asset level. And we're fortunate that within the last 12 months, we had a large South African group looking to invest $275 million into the company at a certain valuation. So we have already a pathway and a valuation for that equity investment at the asset level. So overall, we've recognised where the market is in London at the moment and reduced the size of the upfront demand. They brought it down to around that $200 million mark and financed purely at the asset level.
Okay, and you talked about the 4-year term or the period around the debt facility in particular. There's a minimum recourse and then there's a maximum recourse as well. I didn't really understand that, why you would ever have a situation where you only build a certain amount of the project or only gets up to a certain point. I would have thought it's always out to the maximum to protect all stakeholders and make sure everyone gets their return. How does that part work?
So the debt facility is 7 years in total. It's 4 years after it's built. So it's got plenty of run time for the debt facility. And as I mentioned, we brought the capital cost down to $200 million. We just draw down to a maximum of the $156 million to be able to build the project within the envelope we've described. Within that $156 million, which, as you've indicated, is more money than we need, is a larger overrun facility for the bankers than we built into the engineering. So very roughly, the cost overrun in the in the contingency in the engineering was around 10%, and I think the bankers use 20%. So there's a bit of flex in there in terms of how much we need to draw down. The key there, Chris, as you know, is not to run out of money. Neither the bankers nor us want us to run out of money. So essentially, we're putting in a bigger envelope of financing than we actually need at this point, so that if there are any overruns, that we don't have to get into difficulty or challenging situation raising those additional funds.
Okay, so at the minimum level, you're covered. At the maximum level, that's your overrun facility.
Correct.
Okay. I understood the point around the offtake and having that in place as a caveat on the financing. The export agency stuff, I'm a little less clear on. Can you explain the implications or the guarantees around what has to be in place to get that tick?
Yes, so many countries, UK, Germany, France, South Africa, have these organizations called export credit agencies. And what they are, they're government-backed institutions that provide a sovereign guarantee to a lender that's lending to a project that will buy equipment from and services from that country. So let's just say we were buying a lot of equipment from South Africa. Well, South Africa's export guarantee agency might say to our bankers, then we will provide you with a sovereign guarantee on your debt because these guys are going to be building the project with more than, say, 20% content. I'm being vague because I'm not at liberty to disclose the exact details, but you get the idea. Is the export credit agency is there to support the export industry of that particular country, and it does it by providing a sovereign guarantee to the lender, which for us reduces the interest rate on that debt when we're drawing it down.
Sure. And so what do they need to see to issue that guarantee?
Essentially need to see evidence that more than, and it's different for different countries, but roughly 20% of the engineering products, the equipment that goes into the project, comes from that country.
Oh, okay, fine. And the offtake side of things, as part of the overall mix, as you said, the offtake is pretty much there. Why not build that into part of your financing mix to bring the terms down or to improve the terms? A lot of groups might do that, as you say, to do it at an asset level. Were you blessed with that many options that you could just ignore that, or just in terms of what was available to you, it didn't need to be factored in?
It's a really good question. And, obviously we've looked at it as you're alluding to. No, I think the financing we've got now is cleaner. Once you start pre-selling or drawing down sales ahead of delivery with offtake parties, you're introducing another secured lender, another liability, and it gets harder. I'm not saying we won't ever do it, but I'm just saying is the structure we have at the moment, as those people who are listening were familiar with it, a straight, primarily secured, first-rank secured lender with equity is the simplest structure. Once you start having other people who are prepaying or essentially lending to you ahead of sales, then they get involved in the mix and make it more complicated. The other thing, of course, is that you tend not to get such a good deal with your offtake if you're asking for funding up front at the same time. So overall, I think we've got the cleanest and the best structure at this stage.
Okay, of course. And you've described working at the asset level and the benefits of doing that. Obviously, there's an equity component in there as well. And we've also previously talked about the advantages of how tightly held Pensana is at the London, the corporate level there. What are the implications around the equity raising and trying to improve that free float component of the company as you mature and you start looking at the downstream options that we've talked about previously as well, obviously looking at that hub in Northern England? How do you address that concern some investors may have around a fairly limited free float?
So, no, really good question. And so the messaging to us from London over the last couple of years was basically go and get Longonjo financed. There was not a strong appetite to put money into a rare earth mine in Angola. But having done that, having been able to say that, then there is a lot of interest around the downstream and salt end, and not just in the separation, but going all the way to magnet metals. So we're now in a position where we can go back to those institutional investors and say, look, Longonjo's financed or going to be financed. It's in construction. It's being built. Essentially, we've taken a huge amount of risk out of that side of it. The next bit is the exciting bit in terms of we can now go downstream and realize on those plans, and that fits very much into the area where the generalist UK investors have a lot of interest, which, as you've seen from M&G and others, there's a lot of interest, and there's a lot of interest from the UK government and others. So the key, I think the key is we need to demonstrate we can finance and construct Longonjo, and that then unlocks interest in the UK. And then, to your point, we will be able to bring in additional institutional equity investors into the register, so it becomes more institutionally liquid, if that's the right word. More institutions on the register in London, and raise the profile of the company. I mean, the way we look at it, to be quite frank, is this thematic is so strong. We've seen it recently in uranium. People sit there bemoaning the price of whatever the commodity is and sort of slightly ignoring the thematic. Eventually, the thematic kicks in and the demand's there. We saw with uranium, it was sitting there low for a very long period of time. Then suddenly, over a 3-month, 6-month period, the uranium price takes off. And the stocks that benefited the most were the ones that were nearest to production. There's a notable example, Boss Energy. I think it's gone up. I think it went up from low to high. I think it went up 22 times. And this has been a stock that's been around for a long period of time, waiting to get into production. The uranium price kicks off, and the stock absolutely flew. Well, we kind of see Pensana in the same light, is that, we're ready to go. We're building. We're in construction. We're financed. And every analyst you speak to, whether it be the brokers, whether it be the investment banks, or whether it be the specialist commodity advisors, CRU, Roskills, Project Blue, Adamas, you name them, they've all got rare earth prices significantly higher than today. I mean, we're sitting at $50,000 a ton for NdPr. They're talking 100,000 plus in a relatively short period of time. Well, that kind of uplift in value is going to feed straight through to stocks like Pensana. And so that's great for the institutional investor because they get a direct leverage off the NdPr price by owning a liquid stock listed on the London Stock Exchange. So we think for the thematic investors, people who want to invest in EVs, people who want to invest in the energy transition, this is a pure play investment with very, very high leverage to this forecast rising rare earth price.
Sure. And looking at that uranium analogy, Paul, obviously that has come to fruition, but that conversation was probably going on for almost a decade, where uranium prices had to go up. Obviously, you had direct exposure to that yourself with previous interests. What insulation is there for Pensana around waiting for this inevitability? I think Mark Twain's often credited with the with that great saying about markets remaining irrational longer than you can remain solvent. What's built in? Where are the protections to make sure that Pensana is successful while you're waiting for that logic to kick in?
There's no guarantees, of course, but the two areas we'll share with you, whenever we talk to our customers, these people are going to buy our product, the pricing which we would talk to them about is much closer to the numbers we've just indicated to you, the higher numbers, than they are the lower numbers. In fact, if you went into the market now and tried to buy our annual production of mixed rare earth carbonate, you couldn't find it. It's not there. So basically, the market is short of this MREC. So whatever the price is telling you, that's one thing, the market's short. But secondly, and it's much bigger in rare earths than it is in uranium, the rare earth market is smaller than the uranium market. The uranium market's kicked off because two things. One is because organizations like Sprott and Yellowcake in London have been buying the physical ahead of this price rise, and they've done extraordinarily well. And then the demand side on uranium has finally kicked off. I think there's 50 nuclear reactors around the world in construction. Finally, everybody's recognized we need nuclear for the energy transition. Well, that demand supply mismatch is much higher in rare earths, much higher. So you've got 350 million electric vehicles on the road, according to the IEA, by 2035. We're all going to be generating huge demand on a tiny rare earth market. I mean, if you ask me the number of mines that are going to come on production in 2025, 26, might be one, might be two, maybe three. These are small amounts of incremental supply, whereas the demand just grows every year. So I think we're at that inflection point, or not far off it, in rare earths after a long period. I mean, rare earths has had nearly a decade as well since it last ran. So I think we're fairly close to that inflection point. So obviously, we don't know when it is. But in answer to your question, implied question, are we going to have to wait another 10 years? Absolutely not. I think it's upon us now. And we can see it on the buy side. We can see it, people who want our product. We can easily sell it at way higher price than the current spot market's telling us.
That's all we have time for. Paul Atherley with Pensana, thanks very much for joining us.
Thanks, Chris. Thanks for your time.